Good afternoon, investors, and welcome to our April 11th, 2023 edition of Bull Sessions. Put down those tax preparation pens and keystrokes and just take a break with us for a few minutes. We have an interesting topic for you here today and probably an ensuing episode or two. My name is Mark Robertson. I am joined here by Ken Kavula, fellow warrior in the investing campaign. Good afternoon, Ken.
Good afternoon, Mark. Hi, everybody out there. I think this is going to be a little bit out of character for us, what we're going to do today, but I think if you stick with us, you're going to really enjoy the trip.
All right, and we are joined by a very special guest, a friend of ours who happens to now reside in Houston, Matt Spielman. Good afternoon, Matt.
Good afternoon, Mark. Good afternoon, everyone.
As is suggested on the screen, we are going to talk a little bit about poker and how that intersects with investing. This is kind of a part of our favorite books series, where we're going to take a look at two books we'll describe in a minute. Those of you wondering, the Twitter birds have been somewhat replaced by Elon Musk and the Dogecoin dog sitting there at the table. So I think we'll keep the birds flittering around on our cover pages for a while.
Mark, it is disconcerting. It looks like Dogecoin is actually winning.
He does have a pretty good
the
stack.
biggest pile of chips. Yeah.
Well, he's also holding a hand with not a lot of chits on the cards, so a lot of aces there.
Yeah, and he's being passed another ace, so
yeah.
I think Annie and Joel are going to need a royal flush to beat him at this point. Is kind of what's appearing there. And Matt's actually smoking a pipe, very sartorial there.
And
I'm not sure we should be advertising tobacco for our friend the bulldog here. He looks like he's maybe is that supposed to be a cigar? Is that Churchill-esque? I don't know.
It is, and I think he could win at Westminster if he went for it. Good stuff. All right, we're goofing around a little bit too much here. We are going to be talking about the book by Annie Duke and the two books by Annie Duke and Joel Tillinghast. And it is a bit of a celebration. We did reach our 1,000th subscriber on the YouTube channel, so that will carry some interesting things ahead for us. Well, let's go ahead and get underway. No investment recommendation is attended by anything that we do here. This is all about education, describing some of the history, the legacy of the modern investment club movement, including their methods, techniques, methodologies, philosophies, all that kind of stuff. We will interpret and apply the stuff that we talk about here. If we talk about specific companies, we'll try to remember to disclose if we own them. But if you hear anything here today and care to act on it, do your own homework first, please. Pretty please. And we're a couple weeks away from a roundtable, one in which we will join with members of the St. Louis chapter towards the end of April. That's a couple weeks out. If you'd like to be added to a reminder list about that webcast event, which happens once a month, please send an email to nkavula1@comcast.net. If you have any other follow-up needs or thoughts, our two email addresses are at the bottom. Anything else, Ken?
No, Natalie says that list is really growing. She's gotten a lot of requests in the last 2 or 3 weeks. So if you have friends or family that might want to come do the programs that we have, it's absolutely free. Just drop Natalie a line. She'll put their name on the reminder list, and we'll see what happens.
Cool. All right. All right, here's our weekly reminder of where we're at in the stock market. For those of you that are math phobic, I'm basically gonna stop and do a quick check in on a couple of our favorite segments before we get started with the discussion of the book. Tillinghast is one of the books. That quote is rather important to us. We believe that the types of things that we do and he has done, he is retiring later this year, is basically to boil down and get rid of the clutter and focus on what's important. And this graph is kind of one of those things. It shows the zigging and zagging of the stock market versus a long-term trend, which Jim Clunan would regard that as a line of reasonable expectations. It means that things are just a little bit more on sale than they have been in a little while. And that's what you can take away from that graph at this point. Anything else, Ken?
No, it's a elegant way to present the data. If you're looking at all the colors and all the different ways of data presentation there, I would suggest that you just focus on one piece of the graph every week until you get to the place where you can put the pieces together. It's really a pretty simple, straightforward kind of a picture for you to take a look at. But basically, all it's saying today is that Value Line's idea about how stocks are going to do has fallen a little bit since the last quarter, and the average itself has fallen a little bit since the last quarter. We just want to remind you that that last bar that Mark has made light green now, that last bar in the bar charts there, that's a work in progress and doesn't close till the end of the last trading day in whatever quarter you're in. So here we are, second quarter 2023 for many companies, and that bar is going to move up and down. Stock prices do rise, but they do fall also. Going to move up and down until the end of the quarter, and then it'll freeze. We hope it'll move up towards that blue line right there.
And it eventually will. I just don't know when. All right.
Yep.
Here's the other graph that we visit only quarterly. It's a bit of a headache graph if you're not used to it. Basically, what it says is what we do essentially works. What you're looking at is a multi-year picture of the Value Line forecast, and that's the red dotted forecast. It's the same graph that's on the previous page, those red dots. And all this is doing is comparing what was predicted with what subsequently happened over the next 4-year period. So we just checked in at a point where 4 years ago, we would have expected a return of 11.6%. That's depicted right here on the chart, right where you see the point. And the actual 4-year performance checked in at 9.9. And all you need to realize is that basically the green area is generally, with a couple exceptions, following the red line. So what this basically says, in a nutshell, is that our approach, which Value Line emulates using price to cash flow, their stock studies are the same as ours, this tends to work, especially when you're looking at a collection of 1,700 stocks. So again, chew on this one. Not going to spend a lot of time on it today other than to say that this quarter checked in once again in a fairly favorable position.
Mark, I'm doing a mind meld with about a quarter of the audience that is asking themselves the question, what's significant about 4 years? Can I answer that for them, please?
Sure.
Value Line does all of its projection 3 to 5 years out, and we've just made the very logical jump or the logical assumption that if their projections are 3 to 5 years out, that's approximately a 4-year projection, not precise in any way, but that's where the 4-year idea comes from.
Good thought, because we always use 5, and it could be potentially confusing, but they do that 3 to 5 year thing. Okay, let's keep pressing on. Matt, this is actually in honor of something that you pointed out this week, that most of the banks in the country aren't paying any interest on savings and checkings accounts. And I think it was Josh Brown and Michael Batnick said you should make a copy of this and put it on the back of one of your credit cards. And when you go into your bank to open an account, you should say, you should be paying me more.
Negotiate with them. Well, and particularly when you think of the ones that are paying the least are the ones that, for safety reasons over the last month, at least as the news purports it, are the ones people have been rushing to. And that leads me to think that once safety is assured, some of that might leak back as people realize, what their next bank statement shows.
Matt, I wonder if they're studying psychology in the whole process as well. I felt like they had really increased my interest on one of the accounts I have in my credit union when my average interest went from about 14 cents to about 90 cents. And, I thought, wow, big time. And then I I checked what the percentage payout was and was back in the doldrums again. But I'm wondering if a lot of it has to do with the fact that so many people that save money in different accounts, especially in relatively small amounts, are so used to getting nothing that they don't expect anything from these accounts.
Yeah, totally right, Ken. And there's also economics in their supply and demand. Even ever since the pandemic government payouts came out, the savings rate of the U.S. has been quite elevated. So the other side of that too is how much do they need to offer you in order to have your savings be there? And the price is what the market will bear, and people haven't run from that. The people are, or I'll say money markets are growing, but the still low single-digit percentage of overall savings in the U.S. So I think until a significant amount of people move somewhere else, which is again is kind of counter to the story of safety of regional banks. I'll say these days, just in the last couple of weeks, I don't think that's going to change. They're flush with cash right now.
I'm also taken with the number of younger people that have money in accounts, that invest, that save, that are not even familiar with what a money market is or how it operates. I mean, we haven't really used that tool for, a dozen years, 14, 16 years maybe? And not using it means you have a whole group of investors that are suddenly faced with something they never were faced with before. You can actually get pretty decent percentages out of 1, 2, 3 year money markets now. I'm sorry, I'm confusing myself by saying money market. I meant CD.
Mm-hmm.
Yeah, same thing in
But true for
general.
both.
Well, what we see from a landscape situation is an extremely bifurcated situation. I have accounts at JP Morgan and Bank of America and a couple others that are paying 0.1%. And I'm fully aware that there's some out there that are paying 3, 4, some are approaching 5%. But there's very little in between. And trust me, the average is 0.54%. It's something that we track pretty carefully. So that average is almost meaningless. You've got extremely bifurcated situation. And we'll probably talk more about that. Nick DiVirgilio actually submitted a post, and I'll respond to it when I get my head above water. All right. Last orders of business. Again, just checking in real quick on the groundhog. Still kind of a languishing performance. We still don't have a lot of people beating the market. We still have a fairly unusual situation of the value line arithmetic average all the way down at 71st. Matt's on the list at number 12. Number 15 is important too. I'd like to borrow 23 groundhog dollars, Matt, so I can get up to $1 million.
I'll loan it to you at a low rate.
There you
Not
go.
quite as low as last year, though.
Probably more than 0.1% though. Yeah, some very familiar names up there at the top. Orange County continuing to maintain its lead in. Kim Butcher, number 1 in the individual category there with the Geico mascot. Anything else we should point out here? The cool kids are back. Traverse City Cool Kids.
Mark, I started looking at some of these portfolios, not the top 40, but the next 40, just to see what kind of differences there were as you move down the list.
Yep.
And, the biggest difference that I see is in the next 40, the people that are, really urging themselves to get on this list and would like to see their stocks moving a little bit better. The biggest difference I see is that almost every single portfolio in the next 40, 41 through 80 or 85, has a bank.
Okay. So they need time to
Seems
heal.
to be the differentiator between this group and the next group.
Makes sense. And there's quite a few Ardelyx advocates up at the top of this list, I'm sure. All right, and the monkey's down at 141st, Ken. That should make you happy.
All right.
All right, just checking in real quickly. We didn't really check in on this the last couple sessions. Our best small companies have fallen behind the market. It actually is kind of an improving performance versus what we saw a couple weeks ago. But we do have a little bit of bank damage, which, again, I expect to to dissipate over time. I could be wrong. Some pretty good numbers in terms of expectations right down the middle. And I do think we are faced with the problem noted in the box there. You basically have a market that's turbocharged by a very small basket of stocks. So what that means is the medium and small companies are paying the price, competitive wise anyhow. All right. So we'll just continue to throw good wishes at the screen, salt over our shoulders. Portillo's has moved up to the middle of the list, Ken.
I noticed there, Mark.
And-
Only 10 down now. You know, I'd like to see a little bit more green in that last column there, though. So we'll just sit back and maybe we don't have to look at this every single week. You know.
And I do, and I do want to express great appreciation to the North Florida chapter and Space Coast people who took me to Portillo's for lunch a couple of weeks ago, and that may be responsible for some of that uptick.
I just got a note from Len Douglas, who's a director on the Southeastern Michigan chapter. He says they have some of their chapter's funds in Ford's interest advantage account, which is paying 4.75%.
Sure.
Compared to some of these accounts that are still paying well under 1%. So we know they're out there, Len.
They can be found. Okay, one last comment. It kind of leads us into Annie here. We don't look at this very often. All this is taking a look at the forecasts, the composite forecasts in the value line standard edition, and looking at how much they move around. Think of it as variability, variance, however you want to think about it. And you see the points in history back 15 years ago. It got kind of ugly. And then we had that kind of mini recession, or people were wondering about, what exactly is going on in the middle of the last decade. Here's COVID, kind of threw the analysts into a tizzy. This was the beginning of the ascension of interest rates here. And now we find ourselves back here. And the only reason I point this out is my first reaction to this was fear. Not really fear. You guys know that I don't get afraid like that, but just trepidation, or however you want to think about it. And then I got to thinking, every one of those points in time actually represented opportunity. And when you look at the stuff we're about to cover, like Annie Duke, Annie would point out that maybe the takeaway from this would be you should be searching for where the rhinos are the most confused. Where are the opportunities the greatest? Because every one of those peaks came with an opportunity, a chance to invest in some really cool stocks. So that kind of sets us up for our discussion of the book. Any thoughts?
Mark, I have one person that would like you just real quickly again to explain the two parts of the graph from the legend up here. The yellow is the value line arithmetic average itself. Mm-hmm. Does that tie into the graph that we saw 3 or 4 slides ago?
Yes, it does. It would be no different than those green bars.
Okay. And the variability is coming from where, Mark?
Just simply adding them all up and figuring out the variance of the complete collection of forecasts on a quarterly basis.
Okay, so who was really off in 20? Is that 2020 that the bar is so far above the yellow of the graph? Who is really off there? Is that the analyst being off, or is that the value line being off?
The way I would try to nutshell it is, remember back at that period in time, we would be looking at not just value line analysts, but analysts in general, and wondering, what are they smoking? And it was either in a state of over optimism or extreme pessimism for all the stocks we were looking at back then. I can remember a number of sessions when we would just sit there and go, wow, what are they looking at? And that's what you see in those bars.
Okay, so in that next bar that you've pointed to, the last one you've pointed to before the graph ends, is that an indication that the analyst hit it right on the head that time?
Well, it just means that the amount of their forecast variations went up. That's all the size of the red bars means.
Right, but the fact that it's almost up to the top of the yellow, what's that signify? Anything?
Just that they were maximum confusion. Think of it as
Okay.
maximum confusion by the rhinos.
Okay.
I mean, the least confusion is here down the middle of the chart here.
Okay.
Least confused analysts. So again, from the standpoint of looking for opportunities, that's what we do. We're actually in one of the more robust periods that we've seen in the last 20 years.
You know, Mark, one other thing I'm thinking too, this is a frequent point that Cy Lynch makes, right? We say it as volatility is not risk because he uses it to debunk the concept of beta, of market risk and the efficient market hypothesis, but really it goes even more than that. It's not that it isn't even risk, it is opportunity. It's the opposite of risk.
Exactly. And that's, I mean, maximum confusion, in the field of analysts means that there's opportunities. I can remember, I mean, we're going far longer than I wanted to on the subject, but I can remember back in the late 1990s where we painted a picture at the Mutual Club of Detroit that the analysts were completely baffled by what was going on at Qualcomm. And we had a member of our group that really understood the company, really understood the industry and the field of opportunity. And it was one of the most massive, rewarding opportunities I've ever witnessed as an investor. And the real source of the opportunity was they were having a hard time figuring out what was going on at Qualcomm. So there you go. All right. So let's go ahead and switch gears and talk about Annie and Joel and the books. I think this is a good setup slide. Borrowed some words from you, Matt, but also Ken's favorite quote, one of Ken's favorite quotes from the book. So I think we'll take it away from here. What's your read on Annie?
Well, I think that, and she's on her third book now, and so those are on my to-do list too. But I think this book, as an encapsulation of her observations, is interesting. So she is not Dr. Duke, but because she didn't finish her dissertation, that's actually when she switched. But she essentially was a trained psychologist embedded with the professional poker community, if we use that parallel, for more than a decade. And so these are her learned observations from there as both a practitioner, but also in particular as an observer of all their behaviors and pretty striking personalities too.
Yeah, and I've watched her many times, watching on ESPN or whatever, and she certainly did quite well over that period of time. And Ken, this is just a little foreshadowing. I mean, she's basically going to, or at least we're going to make the link to some of the stuff that she did and part of her learning process, learning from peers and that kind of stuff, to basically form a group where the emphasis was on how do I become a better poker player. I think that ties right in directly to how do we come together and invest better.
If she was a typical doctoral student, Mark, I would imagine that she was extremely surprised at how beneficial applying her knowledge could be in the outside world. I would imagine there was nobody with a bigger amount of skepticism when some of the ideas that she came up with begin to work for her. I think a lot of academics don't ever see themselves as doing anything practical, and suddenly to take a lot of the things from theoretical psychology and move it into practical psychology, and then to move it to a game that conjures up riverboat captains and gangsters with Tommy guns on the floor. I think really drives it home that there's value in what you're learning, And sometimes you have to take a step back and ask yourself, how can I apply what I'm learning to make more value?
Yeah, and what is kind of fascinating is she has transcended that. She now actually serves as a consultant to a number of asset management and um, hedge fund financial firms. So it's kind of fascinating. The other half of our book discussion is Joel Tillinghast. We have actually covered Joel in the past. He has been the manager of the Fidelity Low Priced Stock Mutual Fund. It's a traditional mutual fund since 1989. And they are grooming this team to replace him that you see here. But you can see that he's been on here since the beginning of the chart. He predates the exit of Peter Lynch at Fidelity. One of the ways he puts here's our way of putting the kind of the point on the whole thing. He beat the market by over 5 percentage points during that time frame. $1 invested in the S&P 500 would be $12 here in present day dollars. It's $32 invested in this particular fund. So the difference between 32 and 12. So
And he did that in a method that's very recognizable for anyone in this community, anyone practicing better investing style or manifests principles of investing.
Absolutely, and that's you picked out some stuff that's really kind of compelling. We covered this last week, but these are the type of stocks invested in by the low price stock fund. Again, generally high quality. They do some special situation stuff, but a number of fairly well-known names. It could be a source of ideas going forward in the future. So here's the actual table of contents from the book. A lot of times I'll look at the table of contents and just wonder what I might be most interested in. Either of you guys have a magnet or a hook that drew you to the book? Any of these titles or sections?
What drew me to the book is that
Or should I
you
just
told me we
highlight
were
it
going
all?
to read it. You know, I really felt that I got the most out of the first 8 or 10 sections, and then the last maybe 6 or 7 sections. There's a lot of stuff in the middle of the book as well, but I really like some of the most basic statements he puts forth as almost. Almost the kind of statements that you use as theorems if you were in geometry, and those theorems will be your basis for proof as you move through the rest of the ideas.
How about you, Matt?
It's funny. It's funny you came up with geometry because that's my most common metaphor is again, Joel has his own way. I mean, it's a very similar vocabulary, but he has his own way of approaching it. He sort of has arrived at the same destination, but from the east instead of from the north. But it to me is very much like a geometric proof, right? You can get to an answer in multiple ways with a given amount of information that's there. To me, what really frames Joel's mind, and it's reflected in his career. I mean, the fact that it's not only so long, but at one place. Investing is perpetual, right? If he has a short statement that said, as soon as you have a time frame for your investment, whether you say, well, I'm looking at quarterly earnings for regional banks next week, or I think there'll be a recession this year, or the Fed will start lowering interest rates either in Q4 this year or not till 2024. All those kind of statements are speculation on outside events. Not statements of the strength or quality of your investments. And that's not to say they're necessarily bad. There are degrees of items there too, but I think simply being aware of that and the kind of pressure you put on yourself that could cause emotion to come up and cause you to make some psychological mistakes, silly human tricks, number 2. Really just being aware of that can let you have a calmer approach to your investing. Maybe you'll be pickier. Maybe you won't move so much. And it's funny, we didn't touch on it this week. Of the 900 plus stocks that are in the low cost or low price stock fund now, their annual turnover rate is 14%. So they hold those for 7 years. So they're not in and out in a day. They have a ton of them. More than I would want in my portfolio by orders of magnitude, but they are serious about all of them. They keep them for a while.
Mm-hmm. Well, here's the two that got me. Again, anytime somebody lays simple out there, that's for me. And also this notion of thinking small, because that's obviously got to lead to smaller undiscovered stocks. And of course, blind spots is a good one. Yeah, there's just a whole lot here. There's actually more on the pages of the book. I did find it kind of interesting that he does launch a bit of an assault, kind of an open quandary on some of the methods. And we'll get into that as we go later on in the book. Here's Annie's book, and I will confess that I actually listened to it rather than read it, although I did read parts of it. And she's the one who actually did the narrative, and it was quite an easy listen. And she's obviously a gifted person, and it was just a fun listen. Anything on here grab you guys? There's just a whole bunch of very colorful sections here.
I mean, if at some point I have a lecture or presentation on this whole book, my title of it will be the behavioral case for joining an investment club, and that comes to chapter 4 of the buddy system. The interesting thing was, or what it really struck me as, of course, was because that's not what I expected. I listened to a number of interviews that she did, and I didn't read it till it was published in 2018. I didn't read it until last year. So some time had passed, so probably the details faded a little bit, but I was looking for certain things in decision management. I was not at all expecting her to say, you need to have some friends with you. So having come to that conclusion, and come to that conclusion both from personal experience, but also experimental proof in psychological research was really interesting. And I think it's something that's assumed by a lot in the modern investment club movement, right? It's there. And I think to find out there's really something there, and someone not at all involved with us comes to that conclusion too, is also kind of a parallel to Joel's, right? So the method is sort of has an outside confirmation from Joel. The means, the idea of learning through the investment clubs is confirmed by this evidence.
How about you, Ken? What was your impressions?
Well, I'm not going to say I liked chapter 5 the most, but I was really drawn to a lot of the ideas in chapter 5, where there was never she's pretty straightforward when she talks about how you can get your ideas across, and how argument's even the wrong word, how discussion doesn't necessarily have anything to do with the way you feel about a person, how you can come to ideas that don't compromise necessarily everything you think, but at the same time allow the other person to be heard, and at the third time, if you will, on a third hand, force you to maybe change some of your absolutism just a touch. I just found chapter 5 a very challenging chapter to read, and then going back and reading a couple parts of it again, I found that it gave me really something to think about actually changing in the way I invest. So that's where I came down with my best feelings about pieces of the book. There's great stuff all the way through this book, however, not just in one chapter or in one section.
She spends a lot of time talking about one call, the Seattle Seahawks and the New England Patriots in the Super Bowl, that one play where people believed they should have run the ball and they threw a pass, and they actually threw a very rare interception and lost the Super Bowl. And the outcome doesn't mean that it was a wrong decision. And she goes through a whole section on right versus wrong. And, sometimes a bad outcome is not necessarily a wrong decision. Sort of like a year ago when we picked Generac as the stock for the roundtable. We weren't wrong.
Well, depends on what your goal was, Mark. Okay.
can I turn that enough? And again, I think I'm going to agree with you on this one, Ken. The dissension or the debate part of the book, she makes what I consider to be a fairly magical recommendation. If you're actually having a debate with somebody, you get a lot farther, not by saying you're wrong, but by saying, I'm not sure. How do we explore this or whatever? When you just basically say, this is not a certain thing, we can't be sure, whatever, it's less of an argument, more of an exploration. I think that's a powerful thing. I'm going to use that on you during the next car trip, Ken. And just one last thing. Again, we're spending too much time on these slides, but this notion of tilt, and that's exactly what it sounds like, the old pinball machine tilt. Well, poker players do it. Everybody does it. And she actually uses an example of you wake up in the morning and your stock's down 10%. If you're truly an investor, it doesn't faze you. And if you think about it in terms of a 10-year chart instead of a 10-minute chart, it changes it completely. So there's a really good section on that.
Well, if you're truly an investor, it might excite you, Mark.
Exactly. Exactly.
All right. I think the other thing too is it gets easier the longer you are, right? If you've had a stock that's returned 15 or 20% for 5 or 10 years, 10% variation is probably the amount you actually paid for it in that time. That's where I was after a point with Disney. So it's easy to become immune to it when that's the scale you're thinking of.
Yeah, there's actually a Tillinghast line about that longer in it. Well, here's your slide map, basically mapping out your first impressions of the book. So you aren't kidding.
Yeah.
All right. So, Matt, I'll let you tackle this one. This is just the basic premise of Annie's book.
Yeah. So, thinking in bets and the next slide, we'll talk about this a little bit more, but really in a more general term is more about thinking in probabilities. And there are a lot of things that humans do sort of, let's say, magically, or certainly much better than even the best computers can do, that we could set a machine to do between us. But probabilistic thinking is not something we're not good at. And so that's if there's one axis that really defines her approach for the book or why it's laid out in the way it is because before you can do something about it, you actually have to recognize what part of your outcome was caused by you, was by your decision, and what was by luck. She literally bookends the book with information on that Super Bowl play and the idea of what could have been or what was probably a professional decision to do that, essentially to get an extra down, an extra try with just seconds left, versus the outcome that came on. And Len is commenting, I think, on Generac that the company didn't get your memo, but I'll say there are a lot of companies that talk about managing by objectives, and certainly the market as it punishes or rewards a company for missing or making earnings by a penny, that could learn a lot about this too. Just how precise can we really be in how many variables go in the world in a year. Okay, next slide. Okay. So we often pejoratively say, stock market is a casino, and there's a lot of reasons why people avoid the stock market. And when they're thinking of casino, they're thinking of slot machines or roulette, where your amount of control is very little. And I'll say I thought this even before the book, but certainly it's kind of a leap you have to make with the book. The stock market is a casino, but it's not slot machines, it's poker, in the sense that there is a lot of control you have. No one makes you buy, no one makes you sell, but there's a lot you don't have, right? You are not actively controlling the companies that underlie your stocks. You're not setting interest rates for the Fed. You're not, and this might go a little too insensitive, you're not invading Ukraine or choking back oil, right? There's a lot of things that you don't control. And if you understand that happens, you're a smarter investor.
Yeah, the one thing.
Go ahead.
I'm sorry. Go on, Mark.
Well, I was
just the one thing, Matt, that I don't know if disagree is too strong a word, but I think that poker has one more element to it that the stock market doesn't have. And because the stock market doesn't have it, I think that if we stress the analogy too much, we run the risk of people thinking they have a little bit more control than they really do. Poker has the ability to get inside your opponent's mind and fool them into doing something that's careless, or in many cases absolutely ridiculous. And the stock market doesn't give us that kind of give and take with the companies or the people we invest with. And I think that we need to recognize that that's a big difference between it being completely a game and becoming something like chess. I know that our moderators on television would love it to become a game like chess, because then when they answer, or when they ask some of these questions like, why did this stock go up $2 in the last 4 minutes? They're going to be able to get a concrete answer that they can rely on that will stay the same. I do agree it's much more like poker than it is like chess, but I think poker has that other element that takes it out of the realm of investing. I'll just make that point and shut up.
Yeah, and I think the similarity to poker is stronger in terms of not the same individuals you were talking about, but the participants, the investors, the speculators being humans and doing random things.
Yeah, I totally agree with you, Ken. You don't cause a lot of things to go through. Although if you read a little bit more chaotic point like the Yahoo message board, people have a lot of conspiracy theories or seem to be trying to think that they can corner the market if they spook a few people reading their comment. But people do make mistakes, and
Sure.
There are mistakes to be taken advantage of even if you don't cause them.
Absolutely.
That I agree with 100%, Matt. That part of it, yes.
All right. So we don't want to get into letters from and notes from the chess players out there, so we'll just move on. All right. I thought this was pretty cool because Joel opens his book and closes his book basically with this 5 mistakes. And
yeah, and it's very much like how Peter Lynch wrote. I don't know if it was all his books. I think it wasn't One Up on Wall Street. Beating the Street was very much around the mistakes he made. Right. It wasn't look at me, I'm the best. It was
One Up on Wall Street.
It wasn't One Up. Okay.
Yeah.
It was over my long career. I've made mistakes and I've learned from them, and that's helped me be better. So very similar approach to his mentor too.
Yeah, and I think many of us have seen those rules in different shapes or forms, but they all still apply. And we should make the note that their careers overlapped. I mean, Tillinghast was basically hired by Lynch, and the points made in the forward. And so they did have an overlap for a few years. And Peter Lynch has a very, very high opinion of Joel Tillinghast.
Yeah, I mean, a lot of these are very recognizable. If I'd call attention to any one that might be worth thinking some is number 4, right? So Joel really cautions us against, I mean, a lot of portfolios, certainly a lot of our portfolios are heavy in tech and heavy in biotech, and number 4 is kind of a caution against that. And I think Google, as it pauses, it hasn't gone down, but it pauses, or as it reacted to the threat of Chat GPT, says, we've often marveled at how can Google be a small company in our definition, right? A company that huge, still growing at 20%. Goes through, but if you're able to grow that fast in a market, you can also go away that fast. And you think, see every other search engine before Google, right? It's just till the next best thing comes along, and maybe Meta is the better view of that. Until the next best thing comes along, you can be seriously threatened really quickly.
And Ken, I thought of you this morning because Joel spent the better part of a chapter raging against companies that did not make profits. And I thought maybe you were like standing up and doing cartwheels as you read that.
I used an awful lot of my highlighter mark, okay? I do want to say that I think number 2 in Lynch's list is one of the most misunderstood statements that's ever been written about investing, because usually it's finished with a period after the first word "understand" right there. There's nothing past it, and I think Lynch was much more nuanced in about this idea about understanding, and while he didn't actually say it in 5 words, I think he also made it quite clear that it was possible to begin to understand things you didn't understand. If you didn't understand chips, maybe you could educate yourself to the point where computer chips were something you did understand well enough to begin to differentiate between companies and what they did. So I just think number 2 is so misunderstood by so many people. And I visit clubs where they're all invested in retail and restaurants, and they tell me that Peter Lynch told them to do that. No, he didn't. No, he didn't.
Not exactly. Well,
Yeah.
I want to piggyback on that one just for the purpose of foreshadowing a bit. When you talk about the virtues of a pod or an investment club, I think this one is a killer. And I already mentioned it once. I mean, in the Mutual Club of Detroit, there were 16 of us sitting around the table. 15 of us knew very little about Qualcomm and computer chips. But there was one individual there who happened to have Motorola as part of his resume that explained it all to us. So a club is a way to basically take advantage of, the expansion of knowledge you get by working with a group of people. So
Well,
that was,
and having membership in a number of clubs, like as I do, Mark, I can see the value of a really diverse population, if you will, in the club, a diverse membership. I can remember back to my first investment club, which was focused around a small high school in a rural area, and which drew all of its people from that small high school in that small rural area. We were really pretty parochial when it came to what we could be comfortable investing in. That same club still exists. It's 35, 38 years old now, but it's made up of all kinds of people, and we live all over the country. And the club has become so much more experienced at moving into things that only 1 or 2 people are comfortable with.
mm-hmm.
Yeah, think about that in the terms of what a club might talk about in terms of recruitment, as opposed to it being the people you know or being open to it. Imagine going out after a certain area of knowledge that you should have knowledge of.
Yeah, good stuff. All right. All right. Matt put this together. Compatible investment approaches. He thinks that the modern investment club movement and Joel Tillinghast would get along.
Yeah, I think we could very quickly be on the same page, right? So Joel talks about his investments in terms of earnings yield, which rather than PE is EP, E divided by P, which does help you compare them to fixed income investments, first of all, but also flows into the next points, right? So when we do an SSG or an Eagle, we look at projecting the company's earnings and therefore the price 5 years out. What Joel does, and he's never really specifies how much this varies, but he actually determines the earnings yield he needs or the return he needs, and then calculates how many years that takes. And think about that again, just in terms of someone for who investing is perpetual. If it was really great and it took 10 years, maybe that would be worth it. Or if it comes fast, maybe that's something faster. But it's the same variables, just a different one held steady. For prove, and he doesn't highlight it too much, but I thought, and this is actually the third bullet point, so they're not quite lined up, but the bullet points are there, right? Earnings yield, expected return, and discount rate are things you want to learn to do it, but the only one you know today is earnings yield. And you guys have taught it and brought it to the community, but to me that's one of the key points that's there, right? Particularly PE, right? PEs come and PEs go, but you know what you have now as a an independent check or maybe a micro level check to what the market might give you.
Yeah, in fact, I would jump in and basically say that prove is the earnings yield. We just simply use the numerators, a different flavor of earnings, happens to be projected pre-tax profits, and the denominator, rather than the stock price, is the enterprise value. And these two are basically the same things when you nuance it up a little bit.
Mm-hmm.
How's that, Ken?
I think you're awful close. Matt, I would add one more in the blue side of the slide. I think our emphasis on all of the above investing, especially the emphasis on expectations for return based on the size of the growth of the sales. Notice I'm saying growth of sales, not amount of sales, but growth. I think that hooks right into his second bullet there. And gives us some idea what time frames might be for a slower growing company. Maybe we're looking at a time frame of somewhere around the number of years it would take to get a 7 to 8% growth rate.
Yeah, you're right.
I think
size is
they're
not in that second
very,
bullet at all.
yeah, they're very closely related to each other. Yeah.
Mm-hmm. Yeah, great point.
And I'm just infatuated with that last point in the green, Matt. That's a Walter Schloss moment.
Yep.
And
yeah.
Just
this book was written. His book was written in 2018 as well, I believe. So I think he wrote it in 17. It's published in 18. So this is not an old book we found in the used bookstore and go through. This is him saying it in present tense in the 20-teens.
Good stuff. Okay.
One other thing, just quickly on the upside downside ratio too. So he uses those terms directly. But again, when you're thinking in perpetuity, I think a lot of people, when they're looking at upside downside ratio, going back to thinking in probabilities, they think this might happen. It might go down or it might go up. Joel's emphasis is if you hold it long enough, those are actual certainties. It will at some point be down as low as you think, and it will at some point be up as high as you think, probably. And I think in particular, people tend to be very formulaic on the downside, on calculating a low price, which when we are up straight and parallel kind of lulls us into thinking, well, the low is right now, as long as our PE is low. But if your downside is only a 5 or 10% drop, think about all the people who had regional banks either in their groundhog portfolio or real portfolio. Yeah, I mean, I was looking at, and I have bought Western Alliance after, and my calculated downside was invalid because at a 3.5 PE, it's below not just the average low PE in the last 5 years. Every year, it's setting a new record low. And even looking at prior years' lows are still, well, actually, the other one that goes outside is kind of your experience, Mark. Even looking at the tangible book value, which should be the liquidation value, is way too high. It was 4 times what it went down to 2 Mondays ago.
That's right.
So for the next year, even though it's in its 30s, should the downside of Western Alliance be 750? Yes, we know it can happen. Maybe it should be less, but it should at least be that. And you can get very inflated views of your return if you're too optimistic on the downside.
All right. I'll save my Nokia story for later on the upside downside ratio. All right. So one of the things that Matt's going to underscore is that the two books actually have a very common thread, that being the Daniel Kahneman's book on behavioral.
Yeah, thinking fast and slow.
Thinking fast and slow.
Some of the concepts he won a Nobel Prize for. So this is a preamble, and we won't have time to do the exercise today. But if you're curious about the next 3 or 4 slides, I encourage you to look at last week's bull session and take the system 1 and system 2 exercise. But let's give our instincts some credit, right? If you happened upon 2 different tigers in a day, faster than you can even get a time which tiger you should be worried about, right? And this is something that a number of very sophisticated artificial intelligence algorithms are pretty good at, maybe 5 nines at, but not as good as you, instant, and certainly not as fast as you, without effort. Next page. So that's not just the animal kingdom, which is amazing because it's not us, but think about if you're a toddler and your mom is on the right, or your mom on the left is very happy that you've been coloring. Your mom on the right is not happy that she found out you were coloring on the wall, right? And toddlers don't go to psychology classes to figure that out. They don't study anatomy to go through. They know very quickly how to interact with other humans, and it's very nearly magical. It certainly is something that not a lot of us think very deeply about. Next page. Now, where we get to the point where this is applicable, rather than just being in awe of it, is to understand that these can be learned behaviors too. So I've got 2 aircraft on very dangerous trajectories, and the fact that when you're an airline pilot, you have studied as part of the method of being the pilot, the discipline of the profession. You study these unusual events, these dangerous situations, so much that they get on order of the other 2 slides. Something and sometimes, in athletes you call it muscle memory, right? Things that you don't have to think about to know how to do. Pilots also use checklists to help them walk through unusual situations where they have a little bit more time. But you can literally get to life and death situations that everyone on that plane depends on someone having not the right knowledge to be able to look up and think about, but the right reactions. And so just like they can learn things, whether that's fighting their natural instinct of being afraid of being in a dangerous situation, we can also learn things by learning our natural inclinations and both developing mechanisms to help us work against them or deal with them, but also work on our own habits to be less susceptible to them too.
Cool.
So again, exercise was right there if you look last week, but in essence, the basis of the Nobel Prize that Dan Kahneman and Amos Tversky won was splitting our mind into 2 systems. And of course, this is just a metaphor. It's not that you're possessed, but there are things that your conscious mind, system 2, which Daniel says is what we generally call I, are not aware of, right? So system 1 is a reflexive mind, what he calls. You might call it your subconscious, your instinct. It is autonomous. It is constantly not only noticing things around your world, but filtering them so you don't have to think about them. You don't have to think about every single car around you. You don't have to think about all the items in the living room as you walk by and wondering if they're in motion or not. And this is entertaining to me because, of course, I have a very serious interest in autonomous vehicles, and of course, a computer has none of those instincts, and you have to teach it all of that, and that's why we don't have autonomous cars yet. Because that's a difficult thing. Mm-hmm. So this associative machine, in essence, jumps to conclusions, but for our benefit. It's a big giant filter to spend our effortful thought on only what's necessary. But in a number of mental actions or mental jobs, like investing, which is long term, which is very much something that is made up in our minds, it doesn't do as good a job.
Well, Matt, for one, I would like to thank you for not using the 2 guys logo there instead of
we could substitute faces. I mean, that could work really well. I'm kind of surprised you didn't.
Next slide.
That could get ugly.
So there's a purpose to having an instinct. There's a purpose for this part of the brain to do things that our conscious thoughts, our slow processing is not good at, but it comes with baggage. It comes with downsides. I've listed a number of biases, a number of faults, let's say, in that operation when it's analyzed by our slow thought process. But I think, Mark, is the next slide, you have the whole thing.
Yeah, this is pretty wild.
There isn't really universal agreement on a model, but this is probably as close as I could think of. So in any book you read, in any discussion, I won't say you're just touching the surface. You may dive into a few. You can choose what it is, but this is certainly not an investing issue. It's a thought issue. And anytime you have human thought, you're working on a difficult problem over time, you can run into biases like this.
Yeah, and there's an excellent discussion on it from our friends at the visualcapitalist.com. You can actually look it up using that link on the lower left and actually drill into these. And they actually collected up the ones that are probably most relevant to this discussion of threats to investing behavior. So I just grabbed these. Those are some phrases that you'll recognize in terms of investing results.
Could you back up, Mark?
Sure.
One slide. I'm wondering if this URL should have air quotes around every single cognitive bias as well, you know?
All right, next slide.
They don't lack for pride in their work.
Yep.
Yeah, you know, I think everyone, or it's very common to think about anchoring bias, right? You know, anytime talks about getting back to even or getting back their losses, that's an immediate clue that they're anchoring on their purchase price as opposed to what something's valued for. There's a lot now. They call number 2 self-attribution bias. What does they call it? I'm slipping. My mind's slipping. But a lot of it is. A lot of her book is based on that bias. I'd say the 1 is the self-attribution bias, and then 2 is the familiarity bias or availability bias. Is what she talks about too. Is you have the facts you have, and is that all the facts? And the fact that someone comes along with you and bets against you on an outcome might clue you in that you don't have all the facts, because someone else with different facts thinks differently. But the self-attribution bias fundamentally gets back to that problem of investing as poker. You know, when we win, we're happy and we want to go treat our families to dinner or celebrate in some way, usually patting ourselves on the back. When things go bad, we work very hard to get out of them, but we very rarely, or I don't say rarely, it's much more difficult to turn away and say that was bad luck. The interesting thing here is when we judge others. Now, this is also, I'll say, a Western or individualist bent, but when we judge others, we tend to reverse that. And the picture I have in the full version of this is a car cutting in front of you, right?
Mm-hmm.
Is that, you know, is that someone who's very uncaring? Is that someone who thinks they're better than you, or is that someone who is in a car with a blind spot, or was distracted because their kid was in the back, right? We're unforgiving of others, but plenty forgiving of ourselves. And that's one of the key things. If you're going to figure out what really is your skill and what really was circumstances around you, that's one of the hardest things or most important things to overcome.
Right, so I think we'll go a couple more slides, and what we've done here is collected up a number of the quotes from Tillinghast and a couple other examples from Annie, and we're going to pick up next week where we leave off, but I think we'll cover just a couple more. If you guys want to pick out any favorites or expound on any of these. See, long term.
At the very end, I kind of summed up in the beginning, right? Joel thinks investing is perpetual, and as soon as you have a time frame, not only, you know, are you putting yourself at the mercy of luck, right, external events, but it also is a matter of the information you have around that tends to not be so timeless, as opposed to, you know, a business's strategy, its location, its market niches, those sort of things.
Yeah, and I think the time horizon thing is so important. That example that we've used many times over on the roundtable, where the gains in Microsoft actually offset all of the other losses in the roundtable tracking portfolio. And, you know, again, this notion of being in it for a theoretically infinite time horizon when it comes to an investment club is pretty amazing. And of course, Tillinghast has lived that with 44 years at Fidelity.
I would never have thought, Mark, that you would have chosen the fourth one down, because you're typically, when we're at the round table or when we're doing things just you and I together, you're always out there looking for new ideas that are something that hasn't been discovered and that might turn out to be something, absolutely wonderful, whether it be Generac or Artelex or whatever we're talking about. But I really like the fourth one down, and I'm focused. When I read that and the material around that quote right there, I thought to myself, that's exactly what Nicholson was suggesting you do. Fill a portfolio with 80% boring stocks, stocks that met this very strict uh, uh, idea of successive growth in every year, and in not only sales but in earnings, and stocks that were very reliable year after year after year. And I think that's why he said use it, fill it with 80% so that you can uh, spend the other 20% of your portfolio looking at all the really interesting things, but knowing that your nice boring portfolio is doing all the heavy lifting for you.
Well, Ken, I have a confession. First of all, Matt picked it.
Did Matt pick this one? Okay.
Yeah, I thought about removing it because it irritated me. No, I'm kidding.
Yeah, it was not a dig.
It takes me back. It takes me back to the 1990s and my early investing experiences. You may remember a company by the name of RPM. And I was actually going over our portfolio with a stockbroker, a fellow friend of mine, and we're looking at this boring RPM, which just happened to return 10, 12, 14% a year. And my stockbroker friend said, that's too boring. And I just looked at him and said, I'll take all the boring you've got. and it's just perfect. I mean, that, 10 years in, RPM, extremely steady performance until they had their issue, but it actually returned. But yeah, that's a great one. I like boredom too. I like up straight and parallel.
Just a couple of weeks ago, my old timey investment club met for its monthly meeting, and we had a fair amount of money to spend because we had trimmed back one of our stocks that just wasn't behaving the way we expected it to behave, and we were doing some pruning and everything, and we had our newest member make a suggestion that on the face of it seemed like it was really the kind of mistake a newbie made. But as soon as she had a chance to think about it, she said, let's just buy more Visa. The guy just reported that they're boring and that all they do is make money. Let's just buy more Visa. And the longer we thought about it, the more that idea took root, and we bought more Visa. So
nice place to park.
I understand. It's a good place to park. Yeah.
All right. So this was probably more my slide that you were thinking of, Ken. Core versus non-core, and this could be an hour all by itself, but as Matt has already made the point, there is a difference between speculation and investment, but this actually does give a permission for non-core investing, much like George Nicholson did.
Speculation, right? Reckless speculation is probably what a lot of people calling the market a casino think about, but shrewd speculation, let's say buying a regional bank 2 Mondays ago that morning when it was single digits. That's you can't say it doesn't follow the general characteristics of growth investing that we do, but you can't say it's a bad move either.
Is it more, Matt, than buying a company based on a sandwich?
Well, that's research. I mean, if you wolf it down, that's casual research. If you really savored it or had a few samples, then maybe.
Okay.
Well, catalysts do matter. There's just a whole lot of stuff here to think about, and I think Tillinghast nails
research on Cheesecake Factory.
He nails this stuff for sure. Okay, I think we might. Well, we got to stay one more with speculation. We'll pick up here next week. But that first line, this was clearly my favorite on the slide.
Yep.
That's straight from the book. That's Tillinghast. That's not any one of the three of us.
And he's not quoting anyone else.
But we'll second the motion. Yeah, there's just some really good stuff here. And I do think that one of these days I might actually map out my trailing year of investing and how my I call it I don't know if I'd call it speculation across the board, but my play portfolio, my non-core portfolio, actually offset all of the losses in my core portfolio last year, and it was really kind of fascinating to watch. So it can make sense.
Maybe to help us, anyone watching CNBC, right? The last bullet point: if a stock is pitched as a play on anything, stop. Right? It's a speculation, right? Any secular play on interest rates, play on oil prices, play on whatever. Just understand what you're getting into. Just like you said, I mean, Mark, you have an explicit pot of money for that. You don't even worry about a percentage. It's a different pot to do that. Mm-hmm. And there is honest learning as well as intellectual entertainment to participate in that too. I tried to find, it's kind of like if you imagine one soccer field, and I tried to see how comparable the fields were, with a game of soccer, a game of lacrosse, and pick your other field game going on simultaneously, with the common group of referees, and you call foul, but it's a player playing a different game actually, and we all happen to have money and we buy and sell securities, but you wonder why the market does this, that, or the other thing. It might make sense if you were mainly watch technicals. Or if you were mainly a commodities person or whatever else. But part of separating out that luck and skill is to understand what game is being played at that time too.
Yeah, and in fact, Ken and I fielded questions from the American Association where they were centered on Investors Business Daily. And momentum investing can work. It's a different discipline. It's not what we do. But momentum investing requires a different set of discipline, a different set of rules. And I'm not saying it's wrong. I'm just saying it's different. And this stuff can work. All right.
This might come out wrong, Mark, but I'm not sure that I'm comfortable living in a world where teenagers identify investment bankers and venture capitalists as possible career choices. I'd much rather venture capitalists be much less visible and be much less held up as a paean to capitalism, to things done well and done smartly and blah 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 blah. I think venture capitalists, there's always a place for them, and I tend to agree that progress moves in fits and starts, and venture capitalists help get you through those places where you're stalled. But I just don't think that venture capitalists should be featured as one of the things that makes the system work. Well, maybe I'm completely wrong, but that's my feeling about it.
Well, I think we go through cycles, and I think you're completely right when celebrity is the ultimate outcome of being one of them. And, I can point to Peter Lynch, you can point to Warren Buffett. Those guys did this stuff for a long time before they became celebrities. And there's not much more I can say other than that shouldn't be the ambition. And certainly shouldn't be the path to celebrity. So anyhow, all right, we're going to come back to indexing versus stock selection and underscore this reality that being in an investment club can keep you out of trouble. And we'll leave you with this one straight out of Annie Duke's book. It's one of my favorite television episodes of all time. You're not familiar with WKRP. I can hear people laughing on the internet. I hear cyber laughing. This is from an episode where the boss sends Les Nessman out to the grocery store, and to celebrate Thanksgiving, they're going to drop turkeys from helicopters. And the outcome is a bit rough.
Help me, guys. Who's the blonde that runs around in the program with the high heels?
Well, it's Jennifer, but Lonnie Anderson plays.
Lonnie Anderson running and going, it's raining turkey.
Well,
or something, humanity. Similar. Oh, the humanity, right?
So we will continue this next week with basically picking up where investment clubs keep you out of this type of a situation. I can point to some where my investment clubs have prevented falling turkeys for sure.
So we're really pointing out our age now with this reference, right, Mark?
Well, yeah, we might have to have some live footage just to
What
get
is this,
everybody.
back from the, help us out, Matt, is this back from the 70s or the 80s?
I think it might be. It might be late 70s.
70s?
Man. Good stuff. All right, so we'll come back and these will all be in your slides. You can see some of the stuff we're going to cover. But here's your reminder that we do post these on YouTube, so this session will be there, and we'll actually put together a playlist with all the sessions. It might take us at least 2, if not 3 sessions to get through the balance of stuff we want to talk about. And I do want to thank you. We are at the 1,000 level for subscribers, which means that triggers some other activities on behalf of Kurt and Sean. So we'll be knowing a little bit more about that as we go forward. So thank you so much. This week's image is a tribute. We learned just a couple days ago that Pam Wright passed away. She's a former chair of our computer group at Better Investing, and her contributions were pretty mighty to the realm of investment education. From left to right, Bob Adams out of Seattle on the left. Third from the left is Joe Craig out of Maryland. And last but not least, Mac Almond, who's one of our all-time leaders in the Groundhog Challenge, but he's also was a contributor to the investment education efforts. Mac is out of Texas, but Pam was legendary. I will admit she was a co-collaborator with me on Better Investing articles. We cursed at each other, as Joe said in his eulogy for Pam. But again, greatest appreciation. One thing that I do know for absolute certainty is that all 4 of these individuals cared deeply about the success of individual investors and the modern investment club movement. So thanks, Pam. Rest in peace. So with that, there are some other slides that are here as a bit of an appendix, and we'll pick up where we left off. Anything you guys want to add?
This has been very enjoyable and a nice change from what we normally do, Mark. I look forward to next week.
Okay, so any other questions or comments from the audience?
No, we've kept up pretty nicely with responding. We always can count on our audience. George Mackey just told us that WKRP was on from 78 to 82.
Wow, it doesn't seem like it could be that long ago.
Well, you're old, Mark, okay?
Yeah, and my chip stack is really low. I might see if I can fix that between now and next week.
Time to press the X, Mark.
All right. Take care out there, everybody. See you next week.
Bye-bye.